Okay, guys, like I said, this is going to be recorded. I want to thank you guys all for joining us for this webinar. This is going to be on short put spreads. I got to go over a couple of things, get it out of the way before we get started, though. My name's Eric Wilkinson. Some of you guys may recognize me from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. Been trading my own money for well over 20 years now, and I'm not here to tell you that I'm going to make you rich or that I'm going to make you a millionaire, but I am here to help you take control of your finances, manage your portfolio, and most importantly, manage your own risk. Another little thing I always say is if you have somebody managing your money for you, there's so many fees that go in there that are hidden that you don't even really know about, from the advisor to the funds, even if they're no load funds. Those little fees in there are really eating into your yield, and if you just take the time to do it yourself, you guys can ultimately end up doing it just as well as the rest of them. And I've traded most markets throughout my career. From the Chicago Board of Trade, I've traded everything from stocks, financial futures, commodity futures, currencies, and options on all of those products in all market conditions. Little disclaimer we need to go over real quick. This basically saying any opinions, news, research, and analysis or other information contained here or material provided by ProTrader Strategies and or associate companies or employees is for general commentary and should not constitute investment advice or solicitation to buy or sell any of these securities or strategies. At the end of the day, you guys, and a little side note, full disclosure, we may be talking about stocks or something along those lines that I already have in my portfolio. I'm not trying to get you guys to go out there and do the same thing I'm doing. The reason why is because I don't know your risk parameters and I don't know what's in your portfolios. Therefore, it would not be right for me to tell you guys what I think you should do. At the end of the day, it's up to each individual person's risk parameters, portfolio, and what they know in order to get involved in these different types of things. So please keep that in mind going forward. And the bottom line is do your own homework, and please remember that past performance of any trading system or methodology is not indicative of future results. Anyway, this is going to be income generations. Sorry, I'm having a little trouble speaking today. Income generation with options. And this is going to be using put options. Last week we did it on short call options. This is going to be on using short put options. And we're going to do that by creating a bull put spread. And if you know very much about options, usually people look at puts as bearish, but when you're selling puts, that creates the bullish aspect to this strategy. And we're going to create this as a spread so that we have defined risk. So this is going to be appropriate for people that have smaller accounts, newer traders, and or people that want to limit their risk. So if you have a lower risk parameter, this is going to be perfect for that. It's also nice to have some of these different spreads in your account, even if you're a savvy trader, to implement these, because it is going to limit your risk, and you don't want to have all just naked strategies or all just straight naked puts for that matter. So it's good to have a nice variety of different strategies in your portfolio at any given time, so you're not just a one-trick pony, if you will. And like I said, this is going to be creating a bullish or market neutral type of strategy. At the end of the day, we want this market to go up would be the best scenario, and trade away from our short puts. Or if the market trades sideways, like we've seen in a lot of different underlyings right now, despite the fact that we've seen some market gyrations, there's still several underlyings that have been trading and trending sideways. So that would be a nice scenario too. That way our short puts will decay to zero, and we will be able to keep our premium that we collected from selling this strategy. Ed's asking, by short, do you mean maturity or by selling the spread? I mean by selling the spread, shorting this particular strike that we end up coming up with for that underlying. So we're going to be selling an out of the money put and then buying a further out of the money put to define that risk. So in case it keeps trading downward. And so when we're doing this strategy, we're always going to collect a premium because we're selling a closer to at the money put and then buying a further out of the money put. That's how we're going to collect a premium, because the one we sell is going to be worth more than the one we're buying. Matt's saying he's got no sound. It seems like everybody is getting some sound. Is everybody else getting sound? A couple of people are saying they're losing sound maybe. Sounds good? Okay. All right, somebody maybe at home office, thank you everybody. Somebody at home office will send out a, I'm in an office, so it might seem a little echoey, I'm sure. Plus I have a fan in the background, so if that fan starts bothering people, please say something. So anyway, so we're going to collect a premium and we're going to try and take advantage of this theta decay. We want theta to happen and we want the volatility to contract. So we're going to be trying to pick something that has a high implied volatility percent. And high implied volatility percent means that it has high implied volatility right now in relation to what it has been in its own history. So it's not really going off of the VIX or anything like that. Each underlying has its own implied volatility, and we want it to be at the upper end of its implied volatility, which creates the percentage aspect of that. It's not the historical but volatility. It is going to be a high implied volatility percent, and I'll go into how to figure out that whole thing, or that whole equation a little bit later on when we pull up the actual trading platform. Okay, so the essentials to success on this are picking the right strike. The right strike for me for this strategy is starting with selling around the 35 delta strike. And the reason why I do that is because then our probabilities, delta, if you guys aren't aware, delta is really the inverse of the probability of it being out of the money in a sense. Or you could say 35 delta has a 35% probability of being in the money, which is equivalent to 65% probability of it being out of the money. One thing to note about that is when we're determining probabilities, the probability of our strike being touched is twice that of it being in the money. So for instance, with that 35 delta strike, our probability of being in the money at expiration is only 35%. But the probability of this underlying touching our strike is double that, so 70% probability of a touch. So just keep that in mind. We are talking about the probabilities, and we're looking to play the probabilities, but we know we have a chance to get touched on this, and that's what it's all about. The 35 is not, Edward's asking, is the 35 delta the net of the two strikes? No, it is. That's where our starting point is for selling that first put, and then I will talk about how we find and figure out where our buy is, or the defined risk aspect of that is. Okay, picking the right duration is also another essential. I like to go at around the 45 days to expiration. Now we're going to come into a little bit of difficulty here just because the next options cycle, which is in May, is going to start having a lot of different earnings landing there. So on a couple of them I'm going to look at a little bit tighter, but I usually like to, with this strategy, look at 45 days to expiration, which is right in the wheelhouse right now. or inside of that 35 days. The reason why is if you get further out, this theta decay doesn't happen, which when theta decay picks up, like in this section here, we get 50% theta decay. And what that does is it sucks the premium out of those strikes. So we're going to see this really happen rather quickly. And I would like to be out within 10 or 7 days to expiration. The reason why, although you get a lot of theta decay right here, you start getting a lot of different delta risk and gamma starts expanding on you, and it starts getting a little wanky. So I like to be out of this strategy, and of course we aren't going to generally see this go to zero if we're getting out within this area, but what we're going to look for is to try and get out at about 50% of our max profit, and that way it'll increase our probabilities of success, and we can go on and reallocate that somewhere else. Picking the right environment. Now, I've touched on this as well. The right environment is we need high implied volatility percent for this underlying. Now, for an individual stock, I like to look at this as being something as above 50% IV percent. And if we're going to use an ETF, because that's like a basket of several different underlyings, it usually smooths out that volatility a little bit. So we can lower that for ETFs to about 30%. So for individual underlyings above 50%, ETFs, I'm going to shoot for around 30%. Osman's asking, do you use weeklies or monthlies? That really is going to be determined by the underlying. Going on by picking the underlying, picking the right underlying, this is going to be something that has a lot of players in there. There's going to be a lot of open interest, a lot of volume on any given expiration that we're looking for. So to answer Osman's question, if that underlying, say for instance Apple, Facebook, Google, the ones that everybody always talks about, those monthlies and weeklies have a lot of open interest and volume. If it's something like the ABC or CBS, some of the network ones, they don't have a lot of open interest and volume going on in their daily, so those would probably be ones that I wouldn't maybe even trade on the monthlies and most likely not trade on the weeklies. So it's really the determining factor is the volume and open interest. And the reason why is because if you have to give up 15, 20 cents to get into this trade, and then you have to give up 15, 20 cents to get out because the bid ask is so wide, then you're giving up a lot of your profit by doing that. So I would much rather go somewhere else where it's inside of 10 cents, let's say, and therefore I know there's a lot of players in there, because if there's a lot of players in there, the tighter that market is, because there's always somebody willing to give up a couple of pennies of edge, which is going to behoove you in the long run, because it's not going to cost you as much to get in and to get out. Well, Brian's asking why somebody would ask about weeklies or monthlies if I'm looking at 45 days out. Well, sometimes the weeklies will land closest to 45 days. I usually try and pick the monthlies that is the closest to 45 days. So if it were, say, 50 days out, I might pick that monthly for the 50 days out. The other reason why you would maybe use the weeklies is to try and land just inside of where that earnings event is happening, because I don't really want to carry this on through an earnings event. The reason why is because if you're doing this in a month or in an expiration cycle that has that earnings, you're going to see the implied volatility start to ramp up as we're going into that binary event. And the reason why is because the expectation starts to grow and people start to hedge their portfolio by buying puts, and that's generally what drives up volatility. So I don't want to sell any options strategy in an environment where I'm going to see implied volatility expand on me. I only want to see that implied volatility come off. So usually during market turmoil or for a particular stock having some kind of major movement off some news or something like that, you're going to see that implied volatility spike. So I want to kind of get in there right after that, and when it reverts back to the mean or back to normal, then the implied volatility will come out, and therefore the theta will happen much quickly. A byproduct of implied volatility or volatility expanding is it holds that theta up and it doesn't allow it to decay. And as soon as it comes out, and it comes out quickly, then that theta all comes out at once. So that becomes rather quickly to decay. Yeah, like great example today, there's 42 days to expiration, so that would be the one I would pick. You know, even if it got down to like, you know, 38, 39 days, I'd still probably pick that. The idea is to stay somewhere right between the best wheelhouse is at 35 to 45 days to expiration. I usually like to bend out a little bit towards that 45 days, and you usually can collect a little bit better premium for that. All right, let me see. So, sorry, getting a couple of questions. I'll try and get on to those here pretty soon. Let me move on to the next one real quick. Know your exit strategy before entering. Our exit strategy with this is going to be getting out at 50% of our max profit. So when we get into this, I'm looking at trying to collect about somewhere between 25% and 30% the width of the strikes. So if it's $1 wide, I'm going to be trying to collect around 33 cents, and on the low end, 25 cents for that particular strategy. Therefore, to get out, we're going to be looking to collect about, you know, 15 cents for that, just give or take. You know, if it's a $5 wide strike, then we're going to be trying to get a third the width of that. So, you know, somewhere just above $1.25 for that. And if it's a $2.50 strategy, then we're going to be trying to collect somewhere around $1.60. Okay, does that make sense for everybody so far? Yeah. So, and then for a $5 wide, we're going to be trying to get about a couple of dollars for that. So, all right. So our max profit is going to be our short put. That's the one we're going to collect a credit for, minus our long put. So in this, our max profit, if it were $1 wide, we're going to subtract the credit we received. So if we collected $1 for that, and then our long put, we paid 60 cents for it, you know, or 66 cents for it, we would collect a total credit of 33 cents for that. So that would be our max profit. And our max loss is going to be that difference. So if it's $1 wide, you take basically the short strike minus the credit received, and that, or the strike prices, which is $1 wide, minus the credit we received, which is 33 cents. Our max loss would be that 64 cents or 67 cents. And then our break-even point is going to be that short put strike minus the credit received. So if we did this as a like a 51.50 put spread, it's $1 wide, we collected 33 cents, then our break even is going to be when that underlying trades down to $50.67. Anything below that, we're going to start seeing more losses until it goes through our defined risk area. All right. This is being recorded, yes. So, and one thing I forgot to mention is for everybody that if you're newer to trading options, please go back and watch this again relatively soon after watching it, because it makes a lot of these concepts stick. If I'm running over it and it seems like it's blowing by you because you're newer or something along those lines, then it could make you forget a little. It goes into short-term memory the first time. If you watch it again relatively soon after that, then it goes into your long-term, and that's really what you want. You don't want to go a couple months down the road and be like, hey, you know, that concept we were talking about, I'm missing some of the things. You don't want to have to go back and watch it again and again and again, month after month, until it finally sticks. If you watch it right away, it will make it stick a lot better. So this down here at the bottom is what I was talking about with the implied volatility percent, and you can find it over here. I pulled this up going to the gears. I typed in implied volatility percent and I get it. The first thing I look at for this strategy, or any strategy where I'm selling options, is this has got to be above 50. So anything below that I would start to discount on an individual stock basis. GDX, which is the gold miner index for the junior miners, this is at 50. It's an ETF. My rule for that is above 30, so that one would meet that parameter as well. But for, say, Google, Monsanto just makes it, and like Twitter is just below. And those might meet it on certain occasions, like if there's a major spike that's really out of line, then I might discount that if it was only one time it happened in the entire year, let's say. So knowing the math to create this blue line is really important. And to find the implied volatility percent, you have a numerator and a denominator in your division table. And on the numerator, which is on the top, you basically take where it is trading now, 50, let's just say 50 for math, subtract that by the low, let's say is 3, so you'd have 47, divide that by the denominator, and in the denominator you take where the high is minus the low, and then you divide those two sums, and that's where you come up with the implied volatility percent, which is this number that you see over here on the side. If you go up to the trade page, it also shows it down, let's see, down here. So ADM has an implied volatility percent of 53, and that's because in their algorithm they have that already figured out. Over here on the side, ADM 53.04. On the trade page, it rounds it to the nearest. So this is a little bit more descriptive here. Carl's asking, do I have things script? I don't think so. What level do I consider too high of an IV to trade this? Great question. I don't have a too high to trade. The idea for me is the higher is the better. And the reason why is the higher the implied volatility, the further away from at the monies you can trade. On the put side, I should say, since we're talking about puts, or show on the put side, is implied volatility inflates, you can get further away from the at the monies. And when it reverts back to the mean, then you have essentially gotten really far away, and that is going to decay much quicker. When you're right at around the 50, you know, you could have an argument where probability is that implied volatility could even still increase. So I like to look at it, the higher is the better. And in that, I also want to get away from these earnings events. So that's what I was talking about. These are showing that there is an earnings event coming up in May for the most part for a lot of these. Like you can even look over here and you can see the implied volatility, or the implied volatility over here, and I can tell you by looking at these implied volatilities how they ramp up and then it drops off right after. This is where ADM is going to be releasing their earnings within the cycle. Or actually even, it could be right there. I'm not, that seems a little out of line, but we can go and look at the chart and see when ADM's is, and it's going to fall within that May expiration cycle. Great. Okay, great. People are starting to throw out, Adam threw out, look at BTU. We'll, yeah, please start throwing out some stocks or ETFs and stuff like that that you guys want me to look at, and I will run that through the rules and see if they work out. So please go ahead and do that. One thing about great John, I think John's pointing out that the high IV can also mean that the underlying can move big. Absolutely. And that's what it is saying. The higher the implied volatility is predicting a higher move in that underlying. But what we're looking at is having, when everything gets a little scary, people pump up that implied volatility. But we also are under the assumption that it's going to revert back to the mean. Once the water settles, it's going to clear up and implied volatility is going to drop. And that's what we're trying to take advantage of that. Do I trade this on the indexes? Yes, I do, Helen. If, say, for instance, they have a higher, on the indexes, it would be above 30% implied volatility. So, yes, I do, Helen. One thing is even though it is, say, for instance, LinkedIn, let's just look at LinkedIn for an example right now, because they don't really have the earnings coming out, but they just got downgraded today by MKM, and they downgraded them from a buy to neutral, and they took a big hit today. And implied volatility really started spiking on that news coming up, as you can see. Unfortunately, you can see the earnings land here, which is in that May cycle that I would want to, trade in LinkedIn. And again, you can see over here, it really starts ramping up. It's a little off because they got downgraded and the implied volatility spike. But this might be one where I go inside of that, where the earnings land, so you could figure out that they're basically 13 days after the end of this expiration cycle, which doesn't give us that 35 days, but it puts us right around 20 days. So it's the 21 days. So that's landing right here. That's why it's the highest right there. So in 14 days, it goes from 37 to 87. So that really spikes. So you know you want to stay away from that one, because implied volatility could start ramping up through that binary event, and I don't want to see that. So this might be one where I would look at this, bend that rule of the 35 days out just because they've gotten that massive spike, and get in and out of this relatively quickly. So I would look at, say, the 36 delta, and if we go a dollar wide, we need to at least collect 30 cents, and that's right there at the width of the strikes that I was talking about. Then your risk is 60 or 68 for that. So that's kind of the way we look to set those up. I want to be at the 45 days because you get a little bit better scenario, but because LinkedIn just got downgraded, it could continue to go down on that news for the next couple of days, so I'd want to stay away from that one on that, and I want to get to this May cycle if at all possible. XLU is being thrown, or let me go to BTU first. And so why is that up there? So with BTU, now because it is a $2 stock, I would probably look at, this would be a scenario where I would look to probably just sell this as a naked put, because my risk, if I'm going to do it as a dollar wide to collect that 30 cents, what's the next dollar, right? So I would probably look to do something like this as a naked strategy. So, and you know, it's because it's only a $2 stock, so that would be something I might just kind of skip over for that one, for this particular strategy. And then got XLU. So XLU has only a 5% implied volatility there. So if we go to the charts, you can see it is at the very low end other than back in October. So that would be something I would discount as well. If you guys have any other ones, throw them out there if you want. A couple of that I have vetted already is so cons here, as you can see, they have been coming off on their volatility. It is at a 52-week low. So the implied volatility on this, at least, it must have really come off since yesterday. So yesterday it was looking like it was up in the close to the 50s. So because it's fallen out below that, I would probably discount it. It's a $10 stock with 10 cents to 15 cents wide. That's another reason why I would kick it to the curb. So and even over on the put side, you know, 10, 20 cents wide over there. So that one is not going to make it for me. We did see that GDX, the gold miners, the junior gold miners, which is an ETF above 30, like I said, fits the bill for this. So I would go to look at the 30 deltas here, and a dollar what, so 29.5, 28.5 is not, it's pretty wide though too right now. You do have a tendency to get a little bit tighter markets on that. I have the high implied volatility for it, but I'm not even getting my lowest minimum, which would be 25 cents for that. I might be able to work that for a little bit better and get hit on it. Oh, I'm looking at the wrong monthly cycle. Sorry about that, guys. I want to look at something in the 42-day range. So look for the 35-ish delta, which is 36 here. Go a dollar wide. So we would want to sell that and buy there. And we're right there at the third width of the strikes. It is 15 cents wide for $30 stock. It's right at the extreme edge of what I would want to be able to take for that. It could be as a Friday, and some of these have come off and the markets have gotten a little bit wider during the day. If that's inside at 10 cents, I definitely look to do this. So that one, I'm going to look in my notes and I'll just kind of put a check mark by it. Cons, I'm putting a line through. And then somebody else is throwing out the, what is SPX right now? Throw out, looking at SPX, it's only a 16 for, you know, the market. When the market goes up, implied volatility comes out. So SPX I wouldn't really do. Who else is off there? Sorry, guys. So Nugget, let's look at Nugget. I haven't looked at Nugget in quite a while. Undrun now, I think, is Goldman Sachs also getting thrown out there. I'll check that one out in a second. So with this one, Nugget, this is one of the major reasons why I don't look at Nugget very often, although it has only a 40% implied volatility. The market on this is $1.60 wide. So that is something, that's the reason why I haven't looked at Nugget in a while, because the markets are too wide. Here you're getting down to about 40 cents, but that's still pretty wide for a $70 stock. I mean, best case scenario for, you know, like $70 to $100 stock, I want to be inside of 15 cents. Somebody wants to look at Goldman Sachs. Who was Osmond said Goldman Sachs. Goldman Sachs 46 just misses it. So I'm, you know, in a pinch. I might be able to make that work if I went to like the charts and saw, you know, this major spike out of line right here. That's where the math comes involved, because sometimes you see a major spike out of the blue. It almost never happens for that particular underlying. Then I would probably default to that next spike, do the math, and see if that pushes it into that 50% area. It's, you know, bending the statistics a little bit to fit your goals, I guess, if you will. But in that regard, you could write down Goldman Sachs, and if everything, I also would like to see a little bit of a push up in Goldman Sachs before I try to do that. But that might make the cut. Excuse me. Carr's asking for GIS. So they definitely look like they have, oh, this one looks like, I don't know how this one didn't make it. General Mills didn't make my short list. So the charts, it looks like it's got high implied volatility for sure. We don't have the earnings event because they just had the earnings, so it's not going to come for some time. They came off a little bit, so let's see. 74. Look for our 30 some odd delta. Oh, it's not going to give us very much love here, because we're going to have to go to right there close to at the money. But for this one, doing a $2.50 wide one, hold down the control to do the buy side, 84 cents. That's right there in line with our third width of the strike for a $2.50 wide one. So I'm going to put General Mills on my list of to-dos, and that one, keep your eye out for Monday's daily market commentary, because that one might very well be one that makes the final cut. Because what I do with these is, you guys, through your guys' suggestions, the ones I've kind of already vetted, I'm going to implement some of these on Monday. Getting Yahoo, a lot of people asking for Yahoo. Oh, my mouse is dying. 78. So like I said, I do have position in there. It's not a very good one, but I do. So full disclosure, I'm not doing this to try and get you guys to get in with me. So let's look at the chart just to get an idea. So it's been pushing quite higher, had a big sell-off today. Looks like it's probably going to find support somewhere around here. And somebody earlier on asked if I use like Fibonacci's and stuff like that. I do. The reason why I do is because when I was in college, I actually started out with a psychology degree, and my thinking was I was going to be a psychologist at one point. And then when I started trading while I was in college, I decided that was really where I wanted to go, was into finance. And then I moved to Chicago to trade on the floor of the Board of Trade. And I told people on the floor of the Board of Trade, my psychology minor gave me more insight to the markets than probably my financial degree at some point, because all of this stuff really, if a lot of people are using it, it comes to fruition. And I don't know if I believe in the whole, you know, it's so many petals on a rose and all of that stuff to come up with these natural reoccurring numbers in the environment, and therefore it happens in here. Sometimes it's so many people are looking at it that creates results in that way. So, and I look at candlesticks because that tells me psychology of the market. That's also with the market profile over here, which is the monkey bars and the volume numbers. You know, this is where the most time and volume has been spent for Yahoo, so that's where the perceived value is, in a sense. So in that regard, you know, it may want to migrate down there. So when I'm picking my strikes, I might want to try and be just below this value area or just below this Fibonacci level, which isn't going to be the end-all be-all of it, but, you know, 34, what was it? It was looking right around 33 anyway. So for a strike there, we could look at that. That puts us at our level there. 34 is closest to 35, right? So that meets that. We're inside that $34 area, or 34-cent area, which is a third the width of the strikes. So since we started with that 34, I might even bump it down and look at this, and we're at 60. So I might even look to do that one, being that it's right in line with that Fibonacci level. I know that because my delta is 32, I've got about a 64% probability of Yahoo wanting to come down and touch that. So that in mind, I kind of like this one too. So for Yahoo, I like your guys' picks better than mine at this point. I'm going to look at Yahoo for this one on Monday, if we can still get it to work out that good. As a matter of fact, I'm going to write that I put the 34.32 on that one. Yahoo looks really good for me on that one. So let's see. My mouse is killing me right now. All right, somebody else was asking for Microsoft. Just rolled off the edge. So Microsoft, let's see, 31% implied volatility. That's way too low for me. I'm going to skip that one. This one I have on, this was from an earnings calendar strategy that we did, setting up for the earnings in Microsoft. So that's what that was for. If you guys saw that one, I still have on the longs in there. Do I have a CMG position open yet? No, I don't. I haven't traded CMG in about a month now. I was trading it around all of that, the E. coli scare. You know, this might be a good one depending on the implied volatility. Wednesday, the earnings are right there right afterwards. So that was one thing we forgot to look at for Yahoo. When were the earnings for that? That could have been why it was looking so good. Yeah, see, that's why it's looking so good. The implied volatility is spiking because right after, I would have been buying that one right in there. So that one's kicking out. I just scratched Yahoo off the list because of that. I'm probably not going to do it within just a 7-day window for this strategy. So Yahoo is off, and that's why implied volatility is spiking, and it looks good because we have earnings. So we're not going to do that one there. So on to anybody else. Unilever, when is their earnings? They should be having earnings. I guess maybe not. All right, so Unilever looks like it could be falling within that line there. 53% Unilever, 15-cent wide for a $50 stock, 10 cents wide over here, but look, our deltas are way off. So it's not even close to being able to get a third the width of the strike for one, and our deltas are right there at the 10. So I'm going to skip on Unilever on that. How do you access the right edge on toss for the market profile? Basically, you go up in here and pick monkey bars, market profile. And I didn't change anything on those. I do change them on some of them, like you'll see in the daily market commentary. I have this broken down on a daily segment where it gives each daily's monkey bars and stuff like that. So that has a little bit of tweaking to do. But on to, I usually use that just for the daily market commentators. So this is a good example right here of where you have the outlier move on this spike. I mean, I don't really do American water that often, but when you have that one, and you can see that generally the highs are right around this, you know, somewhere between 55 and 65. You know, take out that one outlier and do your math and see if that lands and meets the rule. So, you know, if you have this major move where maybe something happened with American water, I don't know what it would have been to make it spike there, but you know, in some companies when they get a new CEO or something like that, you get this massive spike. And that's not going to happen that often, right? So you can kind of discount that and do your own math on it to figure out if it's going to work with the parameters. And again, 36%, it may have it, but it's 20 cents wide on a $70 stock. I might pass on this one, and I can't get very close to that 35 delta I'm looking for American water, so I think I'll pass on that one. Another one I was looking at was that I had kind of looked at. I was looking at LinkedIn just because I had that massive spike, but it's only within a couple of days, and as the other has the earnings event coming up, so we'd have to do it for a short time, but it does fit the parameters with the spike in volatility. So this is for the retail sector, and that one came off also. So that was above 30% yesterday. So it came off a little bit today to get it below there, which is surprising with that the down moves we've had. We haven't seen that implied volatility spike in there. Let's look at USO. USO had a big move up today. If you watch the daily market commentaries, off of what I'm saying is dollar denominated, because it's dollar denominated, oil spiked with the dollar weakening against, you know, other major currencies. Some people are trying to say because they shut down the Keystone pipeline. I'm like, that's only about 500,000 barrels. That's not going to really do much. So with this one, a dollar wide, probably not going to get to a quarter. It's not. So this one's kind of fallen off also. So that's not going to meet it. I had XOP on here. EA Sports, I did look at that one. That one kind of, somebody's asking about EA Sports. They do have high implied volatility, but I believe that their earnings lands right here on that. And without even going and looking to see exactly what day it is, I can tell you it is going to land right there in this earnings cycle. So this might be one where you could look to go to the weeklies and go inside that with that 35 days. You're going to be outside of that binary event, but being that close, you could also see implied volatility affecting this monthly cycle as well. So as you can see, it's going to land inside there. It happens on the 10th, and we can get inside that by doing the weeklies. But my fear is as you can see here on this earnings event, it kind of went up to about 80. This one was about 80. This one was a little bit lower, right around 76-ish. So you can see how going into that, it's usually around 80. So it's got quite a bit of room to continue to travel up heading into that earnings event. And it's not unheard of for it to travel up there well before and then just flatline. So that was one that I was looking at and maybe trying to land it inside of there. but my fear is we're at 60, 59-ish or whatever. 30 more points to the upside is going to hurt my my trade. Because we can even look at this. If I were to pick this one, you can kind of play around with these numbers. And for instance, you can go up here and go to the theoretical market value. Just get an idea. If our stock price, let's say we were directionally right in EA Sports, we're selling a put spread in here and it goes up. So let's say EA Sports goes up $5. So we're going to increase the value of $5. We can change this date to be, let me just make sure it's, go to today. Let's pick a few days out. So let's say a couple weeks out. But our implied volatility goes up by that 30% that could be expected. So we get a $5 rally in that. And if we were to sell these strikes in here, we're just not going to get the decay because if, say for instance, it's $1 wide, it's still going to stay within that 30 cents, despite the fact that it decayed. They're decaying evenly, and I'm not going to get my decay that quickly. So, you know, a couple of weeks out, if we were to do that, let's say, what was the delta on this? I have to say the delta is right in here. So if we were to pick this strategy here, and we're doing $1 wide, 32 cents. So that fits the parameter there. But because of what we were talking about, if we get that theoretical increase in price like we wanted, and everything else being equal, it's only going to decay to 19 cents over that next couple of weeks. I'd like to see a little bit faster decay because it's going to get held up. Does that make sense for you guys? See how I talked about that on there? Volatility expanding is going to hurt that. And if we could even trade it to where we said the price didn't even go anywhere, and we're still out of the money, then you can see that price increase is going to hurt us. We're going to start losing money, and that's how theta holds up, or sorry, the increasing in volatility holds up theta. As you can see, I've gone a couple of weeks out, and this is increased in value because of that increase in volatility, and we're not going to make money on that. So that would be my fear, is even if EA Sports trades sideways to up, we're just not going to see any decay in that, because we can assume that it's going to go from where it is now to where it is historically around that binary event. Does that make sense, you guys? Why we would want to discount that one? KMX. $0.10 wide, that looks pretty good. 43% implied volatility. Well, let's see if it had a major spike in there. They just had their earnings, and the volatility is really coming off. So this might be a candidate for that. It's a little bit low on the implied volatility, but we could look at it to want to go. Probably not much. It looks like we missed the boat on this implied volatility, just because of the earnings event. That's what we'd want to see after putting this strategy on, not having an earnings event, is to see that volatility come out. I don't really, you know, on this chart, I have historical volatility, and that was for a different webinar. I just haven't pulled it off. I really don't even look at this purple line for the historical volatility at all, really, to be quite honest. I mainly look at the implied volatility percent. Probably should pull that off so it's not confusing. All right, so let's look at Let's look at XOP. XOP, hopefully it stayed above 30. It's really hard to find. It's above 30, so that one would be one that would fit the realm. And you know, with oil rallying and the dollar weakening against major currencies, this could be a good one to have on for the interim. So we need to make sure we get our delta. I would only, somebody's asking, would you use this strategy if IV were super high and earnings were close to coming out? Scott, I do build this strategy around earnings trades. I've done a webinar on it. I have a little bit different parameters for the specific earnings trades, so you can check out Pro Trader Strategies for that one and check that one out. But earnings trades, I wait to the last minute to put those on. So if, say for instance, EA Sports was having earnings you know, on Monday, I would have put that trade on today, or if it, Monday morning, then I would put that trade on right towards the close. If EA Sports was having their earnings on Monday, but after the close, then I'd wait till afternoon to put that earnings trade on, and then capture that theta decay. I love earnings trades, and during earnings seasons, I'm really involved in those. Just because you know that theta is going to come out of it. So for XOP, we would look to sell the 30s because that's right there at the 35 delta we're looking for, and we can get 33 cents for that. So with the expectation that XOP is going to go higher, this is a good candidate for that. So I'm going to be looking at General Mills and XOP on Monday. I'm going to write down the 30.29 on that one. So that's what I'm looking for this type of strategy. Helen's asking, it could go either way. So would you add calls for the earnings? Yeah, I do. I do a lot of times add the calls also and build it out from there. I try and go outside the market maker move. And like I said, I go into that in detail how to figure all that out too. But I do like the iron condors for the earnings, unless I'm, you know, directionally biased. You know, for instance, like say for instance Disney or something like that. You know, I'm generally more bullish on Disney than, let's say, some of the retailers or something like that right now. Okay, so that's kind of how I would build that out. So XOP and General Mills are probably going to make my short list for Monday to put this on. So if you check out the daily market commentaries, and I'll talk about building this out, and when I put it on, I'll probably do it early in the morning. Does anybody else have any last minute questions for me that you guys want me to go over real quick? Anything I may have breezed over a little too quickly? Okay. How many contracts, you know, with me, it really kind of depends on how bullish or bearish I am on something. XOP, I'd probably add a little bit more to, because I'm a little bit more bullish on oil right now with the drawdown of 5 million barrels that we just saw. I think a lot of people are starting to drive for spring break and things of that nature. So we could see a little bit more of a drawdown with the weakening dollar. I think we could see a little bit more upside to that. So I might allocate a little bit more to that. It all really depends on your portfolio, and I would not allocate any strategy to any particular underlying ETF or whatnot. I wouldn't go more than 10% on any one strategy. So it depends on your portfolio, how much you have in there. But I usually look at somewhere between 3 and 5% of my portfolio on any one underlying or sector, or not sector, maybe 10% in the sector, but 3 to 5% on any given underlying. So that's a good way to figure out what you want to put as your personal number of contracts, somewhere between 3 and 5% for any given strategy on any given underlying, for that underlying. Does that make sense? Anybody else miss the first 15 minutes? This is being recorded, yes. That answer your guys' question on the allotment for that? And that was a great question, I should have said. That's something I've missed talking about in the last few webinars, is don't put all your eggs in one basket. Do we have archived websites? Yes, we do. So on Pro Trader Strategies, you can go, and I forgot to pull this up. So basically on we have an offer that they're going to put in the chat box. So you can click on the offer in the chat box. Basically, you get my daily market commentaries. You get the archived lessons for, you get archived lessons that are like 15-minute segments of these different strategies that we go over in the webinars also. The webinars are definitely more comprehensive. I go into detail, like I said, for a little over an hour. Now we're going over this, answer your questions. It's a little bit more give and take. I think people get a lot more out of it when they can ask the questions and be involved. The ones that are on like YouTube and stuff like that are like 10-15 minutes, and I just kind of run through the rules rather quickly and talk about how to build these strategies. It's nice for a refresher. And then the daily market commentaries, which I do every single day. I talk about economic, geopolitical, market stuff, and how that is going to affect particular underlyings. Like I was even talking about yesterday in a daily market commentary, how it was not making sense. We just had a drawdown in crude oil of 5 million barrels of oil. U.S. dollar was getting pummeled against other major currencies. Crude oil should not have been selling off, and lo and behold, we had it today with the rally. So I give you that kind of insight as to what I'm seeing in the markets, and if that seems a little odd. I also go in, tell you exactly what trades I'm doing, why I'm doing those trades, when I'm defending those trades, how I'm defending them, and when I'm getting out. So those I try and do in less than 10 minutes, which sometimes is a little bit difficult to run through all the trades and or everything that's going on, but I try to get it there because I don't want to bore you guys completely to death with stuff that's not going to be pertinent to what you're doing. But in the chat box, please click on that to the special offer for you guys participating in this. I really appreciate your guys' input. It makes this a lot more fun when you guys are throwing out ideas to me to run through the rules rather than the ones I'm already vetted. So I appreciate that, and appreciate you guys sticking around on a Friday. That's all I got for you guys today, other than if you can't take that, take it easy. Take care, everybody. Have a great weekend.